Finding an edge in IPOs. For those of you who don't know, IPO is initial public offering. It's basically when a company goes public. So it's listed on the stock exchange and you can buy shares, NASDAQ, New York Stock Exchange, London Stock Exchange, whatever it may be. Now 2016 was towards the end of the year. We had a bit of a drought in IPOs, but 2017 I'm expecting quite a lot. There's rumour that we're going to have things like Uber, Snapchat, Slack, AirBnB, to name a few of the high-profile ones. So it could be the year of the IPO. So how does that affect us as traders, as short-term traders? Well, looking back, I think there's quite a big edge in trading IPOs because you have a pure supply and demand imbalance potentially. You have no real history of earnings. All they have is a document which they have to release and all the due diligence before they float the shares. And then, ultimately there's no real charting that goes on. So basically what I'm looking for, my goal of this is to find a strategy that I can use to trade IPOs in the first sort of 1 to 3 month window of trade. After that, I'm not interested. It just becomes another stock to look at. However, it's like a special condition for me when it's in the first couple of months of being first listed. So what sort of edge am I looking for? Well, I'm short-term trader. I'm looking to make as much money as possible with as little risk as possible. So what I'm looking for is something that I can hold for a short period of time, kind of a 10-day trade, a month trade maximum, something like that, some pattern that's repeatable, that maybe has a bit of history to it, that if I see that in these future IPOs, I'll trade it or use it as a bias to trade from, because I think 2017 will have a lot of IPOs and I'm prepared to allocate a bit of capital to this strategy. So what I did is I'm not claiming to be a really in-depth data analyst or approaching this very scientifically. I approach it really from a trader's perspective, a tape reading trader's perspective. So I studied the returns from the IPO date and the close of the first trading day for 2016 IPOs. I didn't really see much of a pattern with that. I'll talk through that in a second. So what I did is I analysed chart patterns from 7 well-known IPOs. I picked some of the 7 big ones in terms of exposure, and then I just eyeballed the charts basically, and I spotted a few strategies. So what I did is I roughly kind of tested those, put those into Excel. I got some data from that, and then I randomly picked some more IPOs from 2016 for companies I'd not heard of, or a couple I had but most I hadn't, just to see. I can say not extremely scientific, but it's enough for me to say, okay, there's a bit of a strategy there. How am I going to trade this moving into the new year? Now, trading wise, if it's a big IPO, you're likely going to be able to spread bet or CFD it. If not, you're going to have to go direct to one of the US brokers, Interactive Brokers, TradeStation, all those kind of things. But some of the big ones like Snapchat, Uber, I will expect that the UK spread bettors will have that pretty quick. They had Facebook and Twitter on available pretty quickly. So let's have a look and I'll show you what I found. So I studied the returns from IPO in the first day close, and the only way I could study it was up until the current day. And actually that didn't give me much data, apart from the fact there's about 100 IPOs that I put in, apart from the fact that basically if you get at the IPO price, 86% of the time you're going to make money. However, we can't get access to that. Most of us can't. You have to have a relationship with your broker, and it's a different ball game. So I'm just looking at it from a perspective of when I can get in, which is the first trading day. And when I sort of back tested or dragged the data out from the first day's close to today, which was a few days ago when I did this, it was about 50-50. Some were up, some were down, some were very good returns, some weren't so good returns. So that's not good enough to get an edge from. So you can't just buy it on the IPO day and say, well, most of them will make money over time, use that as an edge. There's got to be something more to it. So next thing I did is I picked 7 high-profile IPOs. I picked Facebook, Twitter, Groupon, Fitbit, GoPro, Zynga, and Alibaba. Let's have a look at the charts for those. Now, Groupon, we all know about Groupon. It was the online couponing thing. 13 billion they raised in Q4 2011. A pretty dire IPO for them. This is unusual actually when you look through the charts to see it just get hammered straight away. But pretty much everyone lost money. But it was purely a fundamental issue that it wasn't as good as business model as they hoped. They thought the data they had behind it was going to be really valuable to people's purchasing. But I think people just got bored of it, and also a lot of the businesses who were using Groupon were complaining that Groupon were taking most of the money. So anyway, that's by the by. But just have a look at these charts as we go through and just see if you can see some patterns for yourself. Zynga 7 billion in Q4 2011. A little dip down here. Let's get the pen out. A little dip down after the IPO day. Pretty bad first day, but I'm sure the IPO at about 7, so everyone was making money, and that's the first day of trade. Often that's the actual initial offer price around here. Then they trade open at here, showing a bit more demand, and then they'll settle down. But look at this. I want you to just remember this little pattern here. The little dip down, and then the acceleration up kind of a month later. Let's have a look at the next chart. So next one was good old Facebook, 82 billion, decent one, Q2 of 2012. That was really hyped, and pretty much a different story to that, because most people could have some allocation of IPO, and that's suspicious when there's a lot of allocation available, and the average guy on the street is being allocated stock or can get stock because it's Facebook. You kind of think that's pretty highly priced, and actually that's what happened. I remember trading this on the first day, and it was just getting hammered. Whoever was running the book at the time was holding the floor at 38, which is the IPO price, which held, but the next day obviously subsequent. But just look at the dip again and the lift back up. And actually moving on to Facebook on a longer time frame, you can see ultimately how we eventually took out the high of the first day, which is what I'm going to use later on as a bit of a marker point. So remember that the high and low of the first day, I'm going to use that as a kind of strategy to base a setup around. But once it did that, it was off to the races. But anyway, we're just eyeballing the charts at the moment. Twitter next one, 14.2 billion in the last half of the last quarter of 2013. Same kind of pattern, a little bit of a float around, then a rip to highs. Let's go with Alibaba, biggest one, 168 billion, pretty decent that, Q3 of 2014. Look at the same type of thing here. You can see where I'm going with this. Little dip lower and then a rip to highs a few days later. GoPro, we all know what happened to that one. That's in struggling now, but I'm not interested in current price. All I'm interested in is the price action for the first 2 or 3 months after the IPO. You can see we sort of pushed up a little bit, consolidated, then we get the subsequent rip up. And Fitbit, the old wearable fitness devices, pretty small IPO, actually 4 billion Q2 2015. A pretty decent rally from the IPO price, pushed up, and then it just kind of failed a little bit. So those were the charts. So what's the summary of looking at that stuff? Right, so just from eyeball, like I say, the strategy needs to lean long, and there's a couple of reasons for that. One, it's very difficult to borrow stock to short in the first month or so of the IPO. So, or if it is, it's quite expensive. And also, if you look back at some of the returns that you're getting, in terms of the movement, it makes sense to stay long for the risk reward. Now, I'm a guy who likes to go short on things, but I think the supply-demand imbalance is more likely to be on the long side. It's easier to trade on the long side, and the risk reward, generally speaking, is more in your favour. So I'm looking at long strategies only. And also, if eyeballing the chart, the breakout strategy looks viable. Now, what do I mean by the breakout strategy? I basically mean that if you take the first day of trade, that's a candle of the first day. Okay, we have the high, we have the low, and you bracket it like that. So that's day one, basically. There's your high of the day, there's your low of the day. If you buy as the price breaks through the high the next day, that is what I'm calling the breakout strategy. Okay, now if we're going to look at some data in a second, but that actually becomes quite interesting. Now, the theory behind the trade setup is basically once the first day is done, the second day is when you start to see that more demand coming in. That's just like the settlement price, if you like, the first day. Then the second day, third day, fourth day, and so on, kind of cements which way the supply and demand is going. If it doesn't break the high and it breaks the low, you need to stay clear. If it breaks the high, then potentially this thing's going to run on. So that's the strategy number one. Another strategy two, which we'll look at in a second, is buy sort of 13 to 20 days after the IPO. And I put it on an overpriced IPO because I think when I mean that, I mean it's been hyped up, maybe there's a lot of hype around it, but it doesn't necessarily mean the case. But we'll have a look in a second. What I mean by that is you can see that pattern we looked at. We sort of saw that dip, and then the acceleration. We saw that on Twitter. We saw that in quite a few things. So let's have a look at the charts and see exactly what we've got. But first of all, buy the high breakout strategy. So the theory behind this is buying the breakout the first day's high. It looks good. Eyeballing it, like I say, I've not really hammered the back testing, but it looks good. So what I decided to do is say, okay, well, why not if we use a stop of half of the first day's range, and I think that offers good risk reward. Like I say, before and after, I don't want to make as much money as possible with as little risk as possible, but at the same time I don't want to be stopped out on noise. So if we say we'll take half the day's range and we say, okay, that's your stop loss there. If you're going in at the break of the high here, as the price goes through there, the stop loss is going to be here, half of the day's range. Okay, so what I did is, and a target to be determined, but let's look at the data here. So I took Zynga, Groupon, Facebook, Twitter, Alibaba, GoPro, Fitbit. High of the day, low of the day. It's the first day, by the way. I should add that really. First day. The range of the day in dollars. Okay, so it's not percentage-wise, it's dollars. The midpoint, otherwise where you'd have your stop. What the stop value is going to be. So in other words, how far is it from the high? How far is the mid from the high? So that's the stop it value. Where did we go to? The high post break is where did we go to? What's the highest point after the breakout? Okay, in terms of dollars. So Zynga, the high was 11.50, and subsequently the next however many days or months it was 15.91. Groupon didn't actually break the high, so that's giving me a price at the high. Facebook, so and so. Dollars profit. Now that is in terms of dollars number per share. So you can see the high post break 15.91. The high was 11.51. Take those away, and you've got 4.41. So that's your maximum potential profit. Now obviously we're not going to get the very high tick, but we're just using it to work a framework and get a framework on. And this RR is basically multiples of risk. So if you're risking the stop here, $1.25, and you're getting $4.41 as a maximum, so the maximum risk, a maximum reward is 3.5 times your risk. Now this is where it gets interesting, because 3.5 times is pretty good, 2.8 is pretty good, 8.1 is very good, 4.2 is pretty good, 29.2 is huge, as is 16.7. Your risk then on your GoPro trade would have been $2, and ultimately that thing ran up to $96.33. So you've got $63 potential profit. Now we know we're not going to get the high tick, but what we can say from this is there are many multiples of the risk potentially a reward here. So this actually seems a feasible strategy. So what I did then is I said, okay, that looks fine on those stocks. Let me just pick 7 IPO stocks at random from 2016, literally gone dunk, 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 just pick them at random. Twilio, Trivago, Avexis, Protostatis, Syndax, Line Corp, SiteOne. I've not heard of most of them. Trivago and Twilio I know about. Now, each of these gave a profitable trade, many multiples of your risk. These 5 did. However, these 2 did not. You got stopped out on Line Corp, you got stopped out on Trivago. Now, bearing in mind that you're making many multiples, and I think on Avexis it was a very serious move. Bearing in mind that one of these outdoes, if you're getting 3 times your risk, that's undoing all the loss from these 2 anyway. So it's actually, not only is it good from a perspective of probability of it being right. Now I know I've only taken 7 here, it's not a big sample size, probably need to take more, but including that with the other high profile IPOs, 14 IPOs picked out reasonably at random, it's working, looking good. So not only have you got the percentage of profit, but the probability of profit being quite high, you've also got your risk reward ratio skewed in your favour, which is what I like. It's got a couple of things that have got going for it. So what can we conclude from that? The first thing is, what about further investigation? Let's look at that in a second. Let's just skip straight down to this point here, right? Before I do that, let me just run through what I mean by the breakout strategy looking at the chart. So, for example, Alibaba, you would have taken 2 strategies are the buying of the first day break and the sort of 10 to 20 day dip buy. And both of those are reasonably profitable. There's a high of the day, so you're buying there. Your stop is going to be half of that first candle. If you can see, that's your stop loss there. Whoops. There's your buy. It's about a month later, and it's a nice risk reward there. Now, what I didn't go into is where you should exit. We'll talk about that in a very quick moment, but the point is, there's your entry, that's looking good, as is the 10 to 20 day dip buy. How do you time this 10 to 20 day dip buy? Again, this is a very loose and broad strategy, but it's something to look at. Facebook, the high was too late. I don't think you would have taken that too far down the line. You want it in the first couple of months. The little dip buy worked okay, but I think you probably would have been stopped out and actually pulled just up to break even. Zynga, dip buy worked perfectly, as did the first day breakout buy. And what else have we got? Let's move on to the other ones we had example of. Groupon never took out the high, so you never got involved in that. The little dip buy probably worked a little bit of profit there. And what was the final one that we did? We did Alibaba. GoPro, absolutely beautiful one. Breakout the first day and the subsequent dip buy, which we accelerated hard. Fitbit, again, first day breakout good. Kind of messed around a little bit, but there's still profit to be had there. And the same with Twitter. The first day breakout around here, good. The dip buy, good. Okay, so how do we? It's very easy to understand how we're going to take the first day breakout trade, taking on a breakout. The dip buy, I'm not so sure. That needs a bit more investigation. Perhaps a moving average. You'd have to be quite a shallow one because you haven't got that much data, or perhaps something like a lower low or a volatility expansion or something to give you a clue that is tailing off. But look at the pattern here. That little consolidation before the rip up. Look at Twitter, almost identical consolidation before a rip higher. Alibaba, GoPro consolidation before a second leg higher. Fitbit not so much, but you still got that blast up. Facebook was a different story altogether. It was overpriced genuinely. And Zynga, again, little consolidation before a rip higher. So there's something to be said about both of those strategies. So how do we exit these trades? Well, this is with a further optimization and something if you like the idea of this, you can go away and do something yourself. I'm going to do some myself. I think you've got a couple of choices here. You either say to yourself, right, you know what, we're getting a likelihood of 2 times R, 3 times R, 4 times R, etc. So what I'm going to do is I'm going to scale my position as it goes 2 times my risk, 3 times my risk, 4 times my risk, whatever, and have a structured way of scaling. I quite like that idea. Another way of doing it is to say, okay, no, for all or nothing, 10R, 20R plays. So as we maybe move to twice your risk, you pull the stop to break even. Okay, now I know there's some controversy around doing that. However, if we're looking for this sort of 10, 20 times risk play, then at some point we're going to say, well, I'm going to get stopped. At what point do I tighten my stop up? Do I start to ratchet it? Maybe I pull it up a little bit tighter and put 1R when it goes 3R. Again, that's up to you, and I think you're going to have to adjust that to suit the volatility of the stock. But the broad idea of that is to kind of trail the stop up, looking for a huge move. Because if you go back to this table here, you can see that there are times when you're getting 10, 20, almost 30 times your risk. So even if you got stopped out at break even or a small loss on a couple of them, then when you do get on the end of one, you're talking about a nice profitable trade. And actually, when the supply demand imbalance goes like this, it's interesting. This is when you get a catalyst that you will get that big move. Okay, so that's that. And different exit criteria, as I say, trail, maybe ratchet a stop up, maybe using a stop for the whole day's range rather than the half day. Again, just trying to work a decent strategy around it. And then maybe looking a bit more interesting in terms of hype of the IPO. Is it really hyped up one? How much are they raising? How many shares are in issue? Perhaps that influences things. And also the country of the IPO. I've just done US stocks because I think that, generally speaking, Americans prefer to own stock than Europeans or British investors, traders. So perhaps that adds a bit more fuel to the fire. But again, something to look at. The 2 to 4 week dip buy, that's good. And another thing to look at is investigating the return from X days from the first day's close. So perhaps if you're a number cruncher, you can input the data and say, okay, well, if I buy 10 days, is that better? If I do it very systematically, what's the sweet spot from it? But there's definitely a strategy in play there. I'm going to be allocating some capital for this strategy moving into the new year. It fits in with the kind of swing trading approach and special situation approach for me. I like it. Eyeball, it looks good. Rough statistics, it looks good. And so I think the first day breakout is a good trade, as is that kind of 10 to 20 day dip buy. So going to be looking out for those. Hopefully there'll be a lot of IPOs this year. Hopefully we'll get some volatility and it'll be a great trading year.